Right, now this is the second part because we have already started the pre-populated spreadsheet, right? We already started the pre-populated spreadsheet. Now we're just going to continue. So far, what I have done with pre-populated spreadsheet, recording the initial recognition, which was 1st April 2007, was it 1st Jan 2017, right? That's what we have done. Now we're going to try to see what other adjustments that is needed with respect to, because we know that we've been asked to do for 31st of December 2017. From the recognition date, initial date, 1 year, 12 months, right? So we need to work out that. So let's go back to the A part first to see what are the adjustments need to be done for the reporting date, right? So the item that was not taken into the account, one of those items was this, which was a deferred consideration, right? It was a liability, but this was what we did. It was original figure was 35 million, but we discounted it because to reflect the time value factor. We discounted as a discounted figure. Now, this was initial recognition date, 1st Jan 2017. Now we are reaching the reporting date, and now we have the reporting date. These are the additional adjustments that is needed. So we know that 1 year is finished. So that means the liability need to be increased. We need to discount, unwind the discount factor. 1 year of discount factor, we need to unwound it, right? So that means we need to increase this figure by multiplying with the discount factor, right? So to find this out, the unwound amount for me here is going to be, I know the discount percentage was 5%. This is the discount percentage, right? First get the value was 31.7. This is US dollars in million. 31.7. I need to multiply this by 5%, which is the discount factor. So the amount would be equal to 31.7 times 5%, right? So it is 1.5 and this is 1.6, right? Now you need to carefully think how this figure going to impact, right? How this amount going to impact the financial statements. That is what is important, right? How this going to impact the consolidated financial statements, especially what we have is a balance sheet. In a normal case, say suppose if there is no subsidiary involved, there is no NCI involved, only we are working on one particular, say it was a bond and we have only one parent's financial statements only. If that was the case, what we would have done, we know when you unwound, we need to increase the liability. So we would be crediting the deferred consideration liability. That means at the end of the first year, my deferred liability would be 31.6 plus this 1.6. Credit the deferred consideration liability 1.6. That means it increased, right? So when it move on to one more year, it would become 35. That's the aim. But then the debit entry, normally when you deal with this debit entry, right? So the debit charge as to unwinding cost or unwinding charge need to go to the profit and loss account, right? So here, right, let me also write here, right? So unwinding charge need to go to the profit or loss. Unwinding charge need to go to the profit or loss, right? But we know what we have here is the balance sheet, so we haven't given us, they haven't given us a profit and loss account. What we have is a balance sheet. So the profit and loss account entry would go where? It would go to the consolidated retained earnings. This is where it would go and land, right? In the consolidated retained earnings, on that line, under the consolidated retained earnings, I'll just make this now, because I don't have a profit and loss account. What I have here is the consolidated. I have a balance sheet. All the profit and loss account item need to go to the consolidated retained earnings. I would debit the 1.6, right? Now let me pause here for a second to reflect, to see, because this is a consolidation statement, and in the consolidation statement, the NCI also has to suffer, if there is any charge. But what you need to understand clearly, the amount that the NCI would suffer, nothing to do with the parents' figures. So NCI has a right to get the share of its profits from the subsidiary. So the items that gonna impact the subsidiaries profit and loss account is what would impact the NCI. If an item would not impact the subsidiaries financial statement, then that would have no impact on the NCI, right? So now if you just look at the first, this transaction here, and who owns this money? Is the parent owns this money to the subsidiary, and is a deferred consideration from the parents' point of view. From the parents' side is what this is involved, right? So it, because parent has to declare this figure at its present value every year finishes. Parent has to increase its liability, its parents' liability need to be increased, right? So the debit charge would only need to go to the parent side of the profit and loss account, nothing to do with the subsidiary here. So therefore, the NCI would not have any impact in this uh, transaction, right? All the charges would go to the parent side. It is the parent's liability need to be paid in 2 years' time. So it is declared as a deferred consideration, and so any unwounding only need to go to the parent side of the profit and loss account. It has no impact on the subsidiaries profit and loss. If a figure impact the subsidiaries profit and loss account, then that would have the NCI involved, because that means that profit would also affect the NCI amount, right? So here we don't have any NCI impact here for this transaction. So this is the transaction that we would do, right? Debit the 1.6 consolidated retained earnings, and then they credit the deferred consideration liabilities. Now I can go and do this entry straight away, and then that's much easier. So I can see here, deferred consideration liability, I need to go and increase. So here, deferred consideration liability, it's already there, deferred consideration liability, right? On this line, I need to increase the deferred consideration liability. On here, I can have it all. This is the deferred consideration. You could say where increase the deferred, is better to have another line, right? I would have it rather than having everything on the same line. I would have an increase in deferred consideration liability, right? Increase in deferred consideration liability. So deferred consideration liability is getting increased here, right? That's an increase in deferred consideration liability. It's not easy to write everything, enough. But increase in deferred consideration liability need to be increased, right? So how I'm going to increase the deferred consideration liability here? Deferred consideration liability need to be increased, right? And let me also have this column. So deferred consideration liability. Let's get the deferred consideration liability column here, right? So we know we already had deferred considerations. We said it was deferred consideration was here within this number, right? Because it was a current liabilities. Under that, the last column, it need to be increased, right? By 1.6. So that has been increased by 1.6. So I put a positive 1.6. This has been increased, right? So this has been increased by 1.6. That's done. So that has been increased by 1.6. That has been done, right? And the next part of it, right? On the next part of it is the when you increase the deferred consideration. Now it's a reporting date. Nothing would do with the goodwill anymore, right? Now the reporting debit has to go to the retained earnings. And so retained earnings, this is consolidated retained earnings 234, and on this figure there need to be a charge of minus 1.6, right? That's be a charge and a debit. So it's going to be negative 1.6, which is the deferred consideration charge. Negative going to be 1.6. Right? I hope that's clear. Right? That's the entry that we have done with respect to this increase in the deferred consideration within the current liabilities there. And then we have the retained earnings, which is the decrease because of the deferred consideration So this is not deferred consideration. This is the no, this is the deferred consideration. So let me see. This is the unwinding. So this is not deferred consideration. This is the unwinding discount of deferred consideration. Change the name there, right? This is unwinding discount, right? So this is the unwinding, not increase. Unwinding or unwound discount. The unwinding discount of deferred consideration, right? Unwinding discount of deferred consideration. Unwinding consideration liability, right? Unwinding discount of deferred consideration liability is there. So that's the we unwinding discount. We need to reduce the retained earning, consolidate retained earnings, and then the next one is the increase in the current liabilities. That's done. Now moving on to the next item. So the next item that I have here, if I just go back again, now I have reached the reporting date. 1 year has finished. I know the next item is related to the 30th, which is the fair value of the factory. But we were told factory is subject to depreciation, 15 years, right? That was given in the question. So 15 years of depreciation means per year 2 million need to be charged. And we know the whole period, the subsidiary was there from the from 1st Jan 2017. That means the subsidiary was there for the whole period in the current, right? So the full amount of depreciations need to be charged. Let's try the double entry for the beginning. You don't need the double entry. Let's get the double entry. Normally, when you write double entries, we know the asset amounts need to be deducted. This is where the PPE or the factory, right? So I'll write PPE, which is within bracket. So the PPE need to be deducted by the depreciation amount. What is the amount here? Which is because of the factory depreciation. PPE will be deducted. How much? 2 million. Right? That's not a now. Generally, if you don't have anything else, it just simply be blank and say there was no subsidiary, nothing involved here, only one company, then this would have been debited to the profit and loss account, right? But here, what we have is a consolidation. We have parents profit and loss account, we have subsidiaries profit and loss account, and NCI is waiting to take its shares from the subsidiaries figures. So we know this depreciation is related to subsidiaries assets in a subsidiary's factory. So this depreciation would impact the subsidiary's profit because it is impacting the subsidiary's profit. It's going to reduce the subsidiary's profit. NCI would also need to suffer this loss, right? It is not only for the parent. Yes, parent also need to suffer the loss. Why? Parent would have 60%, I think 60% of the shares of this company. At the same time, NCI would also have to suffer it. Why? Because this transaction, 2 million, would be charged against the subsidiary's profit figures, right? Subsidiary's profit figures would be reduced because of the extra 2 million depreciation charge. So the debit entry we would have, instead of having one line, who we're going to charge the debit entry? Parents' figures will be charged to consolidated retained earnings. Parents' figures would charge to consolidated retained earnings. Parent would suffer the consolidated retained earnings. We know, if you read clearly earlier, the parent has suffered how many? It was 60% of the parents. So parent would take 60% of it, right? Parent would take 60% of this 2 million, right? And 60% of this 2 million going to be how much? 60% of this 2 million going to be right, this 2 million going to be is going to be 1.2, and 1 point parent going to suffer 1.2 million, right? Let me take this off. Parent going to suffer 1.2 million, right? So parent going to suffer, right? So we know the parent going to suffer 1 point, this is 2 million. So parent going to suffer 1.2 million. At the same time, NCI also need to suffer some goodwill as a result of this. So NCI need to suffer the depreciation as well, right? So the amount that the NCI would come on. So the NCI, the amount the NCI has to suffer as a result of this, some reason I can't explain this. Yeah. Right. So the amount the NCI gonna suffer on this, if I just copy these numbers here, that's not there. So if I just copy this bit here, we know NCI's out of these 2 million gonna be 40%. That's the NCI's contribution, 40%. That 40% gonna be 0.8, right? 2 million, 40%. 0.8. Now, this is the double entry with respect to the changes that is taking place with respect to depreciation charge. We have to be very careful. Now, I would first go and reduce the PPE figure, that is the by 2 million, right? So I would go there and I will reduce the PPE figure. So this is unbounding done. So my next adjustment is gonna be additional depreciation, work out for the additional depreciation, which was missed out, additional depreciation charge, right, on fair value of land. Fair value of land, right? So I need to work this out correctly. So that's, I've got my heading, and then let me get this down there. Right, so we need to charge. The first would be PPE here. PPE amount will be reduced. It will be reduced by 2 million. And so it will be reduced by 2 million. PPE going to have a loss of 2 million because of depreciation. Year end has come, right? So, but then the charge need to go because it is subsidiaries asset. Charge would be going to the subsidiaries figures. So both would be impacted, parents and also the NCI. So the parents figure would be taken out from the consolidated retained earnings, and then we know it was I think it was 1 point it was 1.2. So parent figure was going to be 1 minus 1.2, right? The parent figure is minus 1.2, right? This is parent figure, which is minus 1.2, and then the NCI figure, which is NCI figure is the, where was the NCI? NCI is here. We already made adjustments, and the NCI would also suffer a loss as a result of charge 0.8 of depreciation. NCI would reduce its amount, so NCI would also have suffered a loss of 0.8 as a result of this, right? That's also done. And moving on next, so this is the figures, and right, good, right? So you can see the double entry. This is credit, asset, debit, the retained earnings, right? So the signs are the same when it's on the assets, one entry on assets and entry on the liability. See, signs are the same when two entries, one on the asset, one on the liabilities, and both entries are going to be on the same side of the balance sheet. Then you would have a plus and a minus, right? Okay, it's understood, right? And that's done. I'm moving on to my next item here. That's done. And I'm moving on to my next item. The next item here, what I have here is the deferred tax liability on factoring. So the deferred tax liability, and this liability of deferred tax was at initial recognition, on 1st Jan, right? This liability was on 1st Jan 2017 when we have already calculated it. Now now we are at the reporting date. Reporting date, deferred tax liability need to be calculated again, right? So how the deferred tax liability is calculated on for 31st of December 2018, sorry, 31st of December 2017, right? 31st of December 2017, we know the deferred tax liability. So we need to get the carrying amount, right? Which is the carrying amount. We need the carrying amount of the consolidated statement of financial positions for the land. This is for land. We know land earlier, right? We started, initial figure was 30 million. That's what we initially recognized the misnomer fair value, but then it has been depreciated for 1 year. What was the depreciated amount? 2 million. So the carrying amount for the land now going to be 28 million. This is the carrying amount of the land, right? 28 million that we have now, carrying amount of the land, which is 28 million. I hope it's clear, right? So, but then the tax base for this 31st of December, tax base is there, right? Tax base would have 31st of December, and they would not have this figure. They would not have this figure in the tax base, the extra amount that they're going to have, 28 million. This is not going to, tax base is going to be 0. There won't be nothing there in the tax base because they haven't recognized the fair value in the tax base, right? As a result of this, right? And you could see, and you could see, as a result of the tax base, and what we have here now, we have a final figure of taxable temporary difference should be, so the taxable temporary difference, that means 28 minus 0. The taxable temporary difference, right? So, right. So what I have here, my taxable temporary difference is 28 minus 0. It's 0. What I have as a taxable temporary difference is 0, 28, right? 28 minus 0 is 28. So this is known as how much my taxable temporary difference should be equal to taxable temporary difference. At what point? At the date of 31st of December 2017. So we know the corporation tax we were given. Corporation tax rate is given, which we were told it was 20%, right? Therefore, the deferred tax liability, right? Deferred, this triggers a deferred tax liability. Deferred tax liability carried forward amount, which is the balance on the deferred tax account. According to the new figures, it's being told we should only have a balance of how much? 20% of this figure. So we should only have a balance of 5.6. Our deferred tax closing balance should be 5.6, right? But we know we have a deferred tax balance in the opening balance. How much is the deferred tax opening balance? 6 million. When 1st January 2017, right? So we already knew there was an opening balance there, right? So this is the deferred tax account, right? Deferred tax. This is the deferred tax brought forward balance. We already have a deferred tax brought forward balance recognized on 1st January. Right? In our books, we have already recognized it. 1st January 2017. And how much we have recognized it? We recognized already 6 million. Right? That was there when we first started. Yeah? It was 6 million, we recognized it. But now we were told, recognize, and now we were told to bring the deferred tax balances, right? Bring the deferred tax balances to bring the deferred tax carried forward amount to what figure? What was the 31st of December, right? 31st of December 2017 figure, right? To bring this figure, deferred tax figure, to what figure? Is to just only to 5.6. See, we were told to bring this balance to 5.6. These are closing balances, right? That's what we were told in 2017 December. So now we can see what we need to do, the missing number. We need to reduce it. And how much by reduce? We need to reduce this 5.6 minus 6. So we need to reduce this by 0.4. We need to reduce this by 0.4. This 0.4 is a reduction. So we know deferred tax liability is a credit balance. When you reduce, we need to charge this. Generally, we would charge this to, let me write this. Generally, we would charge this amount to profit and loss account, right? Not charge, it is a credit. So we would, because this is a liability has decreased, we would debit, I'll write the double entry. Because liability is decreasing, we would debit the liability, deferred tax liability, right? We would debit the deferred tax liability. Deferred tax liability is normally a credit balance. we need to reduce it. So we debit the deferred tax liability. How much? By how much? By 0.4. Then only this balance would become this. It was here, now it will become this. So we have debit by 4, and then we generally, when you do credit, if there is not, if there is no subsidiary or anything involved, only one company, generally we would have credited to the profit and loss account. This is what we would have normally done, right? We would have credited to the profit and loss account. But here we know this asset is related to the subsidiary, right? Fair value increase is related to subsidiary. And then, therefore, the deferred tax changes that are going to take place also related to the subsidiary's profit. And it would impact the subsidiary's profit and loss figures that we're going to get, right? Therefore, it is not good enough only to charge, only to give this credit to the parent, but also we need to give share to the NCI as well, right? So we know generally we would have taken this to the profit and loss account. We can't do that now. Why? Because this is a subsidiary's item. This would appear, this would impact the subsidiary's profit and loss account. NCI has a share on the subsidiary's profit. NCI do not have any share on the parent's profit, but NCI has a share on the subsidiary's profit. Any item that going to impact the subsidiary, NCI need to be get involved. So we have to get NCI involved. So whatever the figure that going to give to the parent would go to the consolidated retained earnings, right? Whatever the figure that we need to give to the parent, consolidated, we need to give to the parent retained earnings credit. So here credit means we would do 60% of times 0.4, right? So credit 60%, 0.4 means this is 0.4 and times 60%, right? That means it is 0.24. So the remainder, again a credit, whom we need to give this credit to? This credit we need to give to the NCI. What was the amount now? NCI has 40%. That's done by 0.4. 40% is equal to 0.4. 40% is equal to 0.16. Now you have to be very careful here. Now this is what I've got these slides here, right? So this is the double entry, right? This is the double entry impact. Now you need to think how is this going to impact the pre-populated spreadsheet, right? So we know one entry going to go to the deferred tax liability, right? Deferred tax liability, we would call this as reduction in the deferred tax liability. Deferred tax liability, generally it is a credit balance, and it is a credit balance, right? So we are reducing it. That's why we have kept it on the debit side of the entry. So this is a reduction in the deferred tax liability. So in the pre-populated spreadsheet, I'll write it here, right? So in the pre-populated spreadsheet, right? In the pre-populated spreadsheets, what is expected from us to do, right? We would reduce this amount, right? We would reduce 0.4 from the deferred tax liability. We would say reduction in the deferred tax liability. That is not a problem. But on the other hand, what we are supposed to do, we reduce it here, and then the entry is on the credit side of the profit and loss account. Credit side, right? That means credit side means we are giving, it's an increase in the retained earnings. These are given to the owners, right? So it is not that we are reducing them, we are giving them to the owners. So a credit means on the profit and loss account, credit means it is an increase to profit figure, right? So when you credit to the retained earnings, that means retained earnings figure should increase by 0. This figure is how much? Retained, consolidated retained earnings on the pre-populated spreadsheet, 0.24, right? This should be an increase in the consolidated retained earnings. It's not a decrease. It should be an increase in the, I hope that you understand clearly what I'm just trying to explain here, right? Then I'll point out the error in the ACCA's answers. So this is an increase because we are giving, we need to reduce the liability. When you reduce the liability, that means we are putting it back to the profit figures. So we reduce the liability, yes, then the credit going to be profit and loss account. Anything on the credit side, that means we are increasing the profit figures. So this need to be increase in the consolidated retained earning. At the same time, we need to increase the um, NCI figure. We need to increase the NCI figure, right? So increasing the NCI figure again, right? Increasing the NCI figure again means increase in the NCI figure again means that this money needs to be given to the NCI. That's what's increase in the NCI. Now you can see here what I've got copied here, right? So this is not right. Now this is what is being done. I got this copied. So this is this what I have now, which is a circling around and around. This is the ACCS solution, right? So you could see they have reduced the NCI. When you minus 16 means that you're reducing NCI. That is not correct. When you minus 0.24 on the retained earnings means it is not correct, because if you increase this liability, if you're increasing a charge, then retained earning would go down. But we are not increasing the charge, and the charge has been reduced. Liability is reduced. So this is a credit to the profit and loss account. We are giving it away to the owners. When you give to the owners, NCI is the owner. If we need to give to the owner, we need to increase the liability. And so we need to pay more to the NCI. So it is incorrect, right? These two are incorrect. I hope you understood. That's why I've just spent this time to show this. Now, the entries are, one second. Right, that's done, right? So just need to go back again to increase this 0.24. And one second, please, keep messages coming up. Right, that's done. And then I just need to record these two. And so I need to first reduce the liability, which is deferred tax liability. So I would go to a column. Now I need to have a column which is the reduce deferred tax liability, DT liability. That's my column going to be. Reduce the deferred tax liability, right? So on here, and I know the differs. Let me get the column clearly. Oops, the earlier one didn't go. This one. Let's get this done. All right. Right. So reducing deferred tax liability. So deferred tax liability was where it is in the current liability. This is my deferred tax liability. And on that, I need to reduce deferred tax liability by 0.4, right? That's my reduction in the deferred tax liability. So minus 0.4, right? So that I've done the reduction that's been recorded, and then I need to give this to I need to give these two figures to the retained earnings figures. And now this is again, let me take this again. What is this? The solutions? It proves wrong again. I just want to make sure that you understand clearly. Let me take this again onto the other side to show you. And so then it also proves why this is wrong. Because you see, I'll copy this here. Right? This is what they have as their answers. And I know I need to reduce this, right? I need to reduce these figures. I have reduced this now from my deferred tax liability. So credit need to go to the profit and loss account, which is the retained earnings here. And the retained earning figure need to be increased, right? Retained earning figure need to be increased by 0.24, right? Increased by 0.24. And right, this is increased by 0.24. And that's one. And then NCI also need to be increased. Next figure here, NCI also need to be increased by 0.16. NCI also need to be increased by 0.16, right? NCI also need to be increased by 0.16, right? So now you can see, like I said, what we have here on the equity side, we have liability side. So if you're going to put a double entry on the same side of the balance sheet, we need to have positive and negative sign for the double entry. See, these two are positive. This is a negative side. So the balance sheet should balance, right? But if it is on a asset and then the other double entry in the liability side, then we need to have the same sign, right? Say, for example, here. And so here, I'll give one next. Say here, this is on the liability side, this is on the asset side. We have the same sign. But if you have a double entry where that both entries are within the same part of the balance sheet, see these two entries are on the balance asset side. So we have one entry is plus, the other entry has to be minus, right? And here, so here we have both entries are on the liability side. So we have to have a plus and a minus. Otherwise, it will not balance. So this was not correct. It was a mistake again, I reckon, right? They accidentally typed -4. Like I said, it's not easy to do live presentations, right? I understand it. Right. So that's corrected, right? So make sure that you understand the difference, what is being done there. And that's done. So I'm moving back again. So I have recorded all my transaction with respect to this particular transaction. Last one was the deferred tax. I've got everything done. Now I'm ready to move on to section B's double entries. And why? Because I need to, this was done on 31st of December, so not much issues I have here. I just need to get the numbers that was not put into the account. That's what I need to do. So we already made note of the double entries, and when we did here, see, we already made note of this double entry here with respect to this, right? So with respect to these transactions, which they have done, and we said, and one of the mistakes that they have done, they did not put the entry, they made an entry into the credit account, and so they credited the revenue accidentally, right? So debit has to be cash, credit could be equity account, right? Because this is this is a transaction between the owners. Who are the owners? Parent and then the NCI. So it has to be a transaction between the owners. Debit gonna be cash, credit has to be the equity, changes in the equity, right? So we are expected, we did the adjustments in the parents' equity. This is what we calculated, adjustments in the parents' equity. So the double entry for the adjustments in the parents' equity here, this is double entry for that. So cash debited 22, credit gonna be the 15.8, and then the group equity going to be 6.28, right? Now we have an issue here. I also point out why. Let me first do the easy entry. This has been recorded according to them. They have recorded this, right? So if I just go back again, and with respect to cash figures, and so they said, and there's what they said was this, they said the cash proceeds of 20 million were received from the sales, and with the other side of the accounting entry, right, being recognized as the other income in the consolidated statement of profit and loss. No other accounting entries have been recognized in respect of this share sale. So when they say no other accounting entries, they have done these accounting entries for this cash entries being done, but accidentally, instead of crediting the equity, they went and credited the other income. That's the one that mistake they did, right? And that's done. And then let's get this clear now. And so with respect to this entry, I just would like to show you something, right? With respect to this entry, and if I let's do the easy part. We know then the NCI need to be increased. Credit NCI means NCI need to be increased by 15.8. Now go back to the C. So we know the increase in the NCI. We have the NCI column already, right? We have the NCI column already. I could simply go to the NCI. NCI need to be increased. So here we have the NCI increase. So I need to have another. I can't just simply add it there, right? So I just need to have an increase in the NCI, right? Let me have another one. This is the increase, right, in the NCI. I would have an increase in the NCI, okay, date, right? And so the increase in the NCI need to be what? It was 15.8. Or you can do like this, and instead of having increase from the NCI, I would have the disposal of shares. This is the disposal of shares, share disposal rather than I'm saying, right? This is the share disposal, so that's the main transaction, and then we can bring all the. So this was a share disposal that took place, right? So during the share disposal, we know this increased, NCI increased to 15.8. So I can increase the NCI by 15.8. So if I scroll down to find my NCI from here, right? I scroll down to find my NCI. Right? Scroll down to find the NCI from here, and you could see this figure here, right? If I scroll down to find the NCI, that is 15 point, NCI gonna be 15.8. Yes, 15.8. So NCI need to be increased, so it is gonna be 15.8. NCI has been increased by 15.8, right? NCI has been increased by 15.8. That's been done. NCI have been increased 15.8. But on the next item, what I need to do, the next double entry with respect to this, we know the cash entry, according to them, they have done the cash entry, right? This is what I guess. And then the remainder, which is the equity, and then they say that so they said they made a mistake with respect to this 22 million, right? So this 22 million was regarded as the other income. So that it is gone into the profit and loss account, right? So this 22 million has gone into the profit and loss account. So that was wrong. And within this 22 million, within this retained profit, so we have this retained profit here. And where was the retained profit equity numbers? And so we have this retained profit here, this number. So the 22 million need to be taken out from there, right? Because why? Because that was incorrectly done. So we have done the correct adjustments. We removed it. It was wrong, right? It was wrong that it shouldn't be there, right? 20 million shouldn't be there. And so the next part of this going to be, and so according to them, and if you just quickly, 1 second, if you just work this out clearly, and the next item on here with respect to this is going to be the which is going to be the 6.2, right, which is the equity. Now this is where that we have slight issue here with 6.2. This need to be credited to the equity. This need to be credited to the equity, right? This need to be credited to the equity, okay? And why? Because is changes in the equity. Now let me take you back to I'll show you why I'm doing this way. And if I just take you back to the chapter 13, which is disposal, and this is the area. See here, we have a subsidiary disposal where the control is retained. That's what the questions we are doing. Now we read it, disposal where the control is retained. right, occurs when there is a decrease in the parent's holding in existing subsidiary through the sales shares. That's fine. It is known as decrease in controlling interest. Perfectly fine. So the treatment in the group accounts is driven by the concept of substance over form. And so we know that I explained there has been no disposal because the structure did not change. The entity is still a subsidiary. So no profit or disposal need to be calculated or recognized. Instead, what we need to do, the transaction between the equity holders, who are the owners, parent, and then the NCI, right? Equity owners, that the parent is selling 15% to the NCI, right? That's what we did. And therefore, it is recorded in the equity as follows. The first one, we need to increase the non-controlling interest in the balance sheet, which we have done, 15.8. Second, we need to recognize the difference between the consideration received and then the increase in the NCI, what as an adjustment to equity. We know that was 6 million, right? That adjustments to equity as what? Post this to the parents column in the consolidated retained earnings. Now, this is the issue, right? I'm just going to follow the same as this, right? As a consolidated retained earnings, where the solutions you would find it is being put through other comprehensive income, right? It is being put to other comprehensive income. So I'm going to put this through the consolidated retained earnings, right? And I just want to show you why I'm doing it, right? Then you understand it. And right, let's make a move. So I need to put that figure into consolidated retained earnings, right? Right, into consolidated retained, which is 6.2, right? This 6.2 need to be added to the consolidated retained earnings here. Now, this is the consolidated retained earnings. If I've removed the 22, right? I've removed 22, and then I'm going to also add here, which is 6 point, what's this 6? Which is 6. So this is 6.2, I think. And I've removed 22, and then I added, one second, 6.2, this one, which is credited, right? So I'm adding 6.2 there, right? So I'm adding 6.2, and you could see that balance. It balance sheets, and it balances afterwards, right? So let me put in green because I know you like green. Right, let me just quickly show you. See, minus 22, just show you the double entry. Then you can see plus 6.2 is equal to 15.8. See, because the entries are on the one side of the balance sheet, which is the liability side. So we have a negative. So the double entry has to be opposite signs. So we have a negative 15.8 if you net this off, and we have a positive 15.8. And you understand is what I'm doing it right. Okay. So if you look at the solutions, they have done this through the other comprehensive income. I just simply wanted to put this through retained earnings because this is what we have done. Comprehensive income, even the remeasurement gain, when we've been advised to put them through comprehensive income, not under other comprehensive income, right? So we put them through retained earnings, and then we have a solid reasons why that we are following it, right? So it's not that I'm making a mistake, right? Right. Okay. So I've clearly explained it why that I have taken that route. Right. Moving on further, and so that's the last entry I think I need to do on this, and that's done. And that was the last entry on C. And so this was a part B I've reckoned. So I've done the double entry on this. So all the entries been done. So that's done. So I'm completed on this. And then you've been always advised not to worry about the total column, right? So total columns are there. It is for me from me to you, but then you don't worry about it in the exam, right? Because you don't want to wait. Because I don't, to be honest, even though they're saying, and then in the exam, it's not that difficult because you're just going to put a sigma sign using Excel and then just drag this across, right? If it doesn't balance, that's where that you won't be happy, right? So it's better that you don't do them. I'll update and I would share the Excel file, right? I will update and I will share the Excel file. So I'm not too sure this get copied correctly. It's good.